Hey folks, it's Chris Richards with Richards Mortgage Group. Hey, this video is going to be a little bit about some logistics required to purchase vacant land or a cottage or a cabin or some sort of non-conforming property. When I say non-conforming, I mean it's likely not eligible for residential or home type mortgage financing. So the challenge that you get often is where you're searching, the lending rules are very specific on non-conforming properties, are very specific as to down payment or property type. And so there's no carte blanche answer as to what's financeable or not financeable. So as you start to conduct a search, it can be difficult because you don't know what would be your down payment in this zone or that zone. Now for vacant land, the default down payment is 50%, which is quite a bit of down payment for most people. Likewise, if you're buying, let's say, a piece of land and it has say a cabin on it, but the condition of the cabin or the foundation or lack of septic or power or any number of reasons make it non-conforming, it's very difficult to be able to purchase with certainty. So in this video, I'm going to talk about a strategy where you can use what's called a re-advanceable mortgage to help finance the property that you're trying to purchase. A re-advanceable mortgage is a mortgage that goes on your home property, not your target property. So you need to be a homeowner with an equity position in your property that's reasonable. What that means is, what is your property worth versus what do you owe on it. So if you have equity within your current home, there's a way that we can prepare you to conduct a property search, knowing that you will have financing in place when that property comes up without having to make that property purchase subject to financing approval, because we can get that done in advance. So what is a re-advanceable mortgage? A re-advanceable mortgage is a special mortgage that you stick on a property that you already own, where you can be pre-approved to what's called a global lending limit, and that's the most debt that you can carry based on your home property or the equity within your home property. If you have a property, say, worth $600,000 and you owe, say, $300,000, you can finance as much as 80% of the 600 for 80. You only need 300. That leaves $180,000 available in a line of credit that you can access with the stroke of the pen. So let's look at a quick spreadsheet, and I'll kind of show you how that re-advanceable mortgage works. Let's look at a quick example of how a re-advanceable mortgage might help you acquire a property in BC. Perhaps it's a vacant lot and you're going to build on it in 5 to 10 years. So the re-advanceable mortgage is actually based on your home, wherever it happens to be. Let's say it's in Calgary, and let's say your home is worth $600,000. When you set up a re-advanceable mortgage, the global limit is set at 480 in this example, or 80% of the appraised value of your home. This is the most lending that your property can support. Now, if you already own or already owe on your mortgage, let's say $300,000, we replace that mortgage with a mortgage within our re-advanceable mortgage. So in this graphic here of the global lending limit, 480, 300 of that is a regular mortgage, no different than what you already have. The magic of the re-advanceable mortgage is you now have $180,000 available in a home equity line of credit, and that's available to you at a stroke of a pen. Now, if you're conducting a search and it's taking a little bit of time, I just want to show you why it's called a re-advanceable mortgage. If, for example, your mortgage went down over the course of time by, let's say, $10,000 before you found your ideal property, let's say $20,000. Look what happens to the HELOC component. It actually becomes $200,000 over time. So what's happening is, as you repay your mortgage, it is re-advancing to your line of credit. So that's the beauty of a re-advanceable line of credit as opposed to a regular one. Now let's just go back to our example. We have a $300,000 mortgage. You have a $180,000 line of credit. The property that you're looking for in BC, let's say it's $150,000 lot. You can go find that lot, make an offer, non-conditional, and stroke a pen, stroke a check on your line of credit for $150,000. So now just to recap, you've got your $300,000 mortgage. You now have $150,000 that you've advanced on your line of credit. You're paying at least interest only on that. And you have $30,000 left over on your line of credit for perhaps some other expenses. If you were going to keep that property for, say, 5 years, you could actually convert that line of credit, which might be at prime plus a half, to an amortizing, perhaps a fixed rate loan. So in this example here, we'll convert that $150,000 from line of credit, and we'll convert it to an amortizing loan. Now I have my regular mortgage. I have a $150,000 mortgage that was used to acquire my vacant land, and I still have a line of credit left over. And as I pay down this mortgage, this line of credit is going to increase. So once that readvanceable mortgage is set up, you're going to have your underlying mortgage that represents the mortgage that you currently have on your home. And now you have this available limit on a line of credit where you have no balance and you're not paying any interest expense on that yet. But now you have the capacity to go out and search for properties without having to understand the vagaries of financing for that particular property. You can simply know that you've got the financing already in place because it's been prearranged on your own property. When you have the financing that's already prearranged on your existing property, now you can go into making an offer on a property. You can be aggressive on pricing. It can be non-conditional in situations where there's a competitive bidding market. The loan on your residential property will be cheaper than a loan on vacant land. Maybe half, home mortgage is about half what a vacant land loan might be. There's tax benefits if you set up with a readvanceable mortgage because there's call it a pie of lending available, and you've got a slice to your home mortgage and a slice to be used for your recreational purchase. There's some tax advantages when you can segment those two mortgages. The interest can be a tax deduction. If you're going to hold the loan for the vacant land for, let's say, 5 years, you can actually convert the line of credit to an amortizing loan to reduce your interest expense. So you can get access to best mortgage rates for your non-conforming or your vacant land purchase. So I just want to fast forward to a point where you now have what I call keys to the gate. So in the readvanceable mortgage, I've illustrated how you can get your financing pre-approved so that you can go out and make your purchase. Now down the road, you're going to want to develop that land or potentially develop that land. And when that land gets developed into a financeable residential property, then the financing can shift from your personal home back onto your recreational home. I have a web page. It's called A Mortgage Financing Guide to Developing Vacant Land. We talk about all of the requirements as are required to finance or develop vacant land and to finance it, including what are you creating. So the property you're creating has to be financeable, real estate that is financeable. You have to have the cash required to make it through a construction process. The readvanceable mortgage that I'm describing right now is an excellent tool to help you manage cash flow when you get to that point. Ultimately, when the property that you're creating or developing is financeable, it can be refinanced or part of a construction mortgage. When those funds come back in, you can take a lump sum and put it back against your house mortgage, and now you've got that capacity freed up for down the road. So to summarize, if you're trying to buy a getaway place, if the property that you're trying to buy meets residential lending requirements, then a residential mortgage is available. If the property does not meet residential property requirements, i.e. it's vacant land or it's a cabin and it doesn't have a bathroom or septic or whatever the reason is, then vacant land lending rules will apply. They have much larger down payments and the rates are higher. So the Re-advanceable mortgage is a strategy where you already own your own home with an equity position where you can get your financing pre-approved based on your own home and then write a check for that property that you're trying to purchase. So I'll put a link in the notes where you can read up on a mortgage financing guide to developing vacant land, and also a little bit more information on how the Re-advanceable mortgage works. As a mortgage broker, I'm happy to help you. There's an old saying that says, support those who help you succeed. As a mortgage broker, I am a commission-based worker. In most cases, the lender will pay me my commission for helping you arrange your funding, and there's no cost to you. So if you like this video segment and want to access my knowledge now and for years to come, I'm happy to help you with your mortgage requirements.